The S&P 500 has jumped 16.5% since April lows, leaving investors like me feeling a little bit happy as my Trading 212 portfolio is up over £10,000 since then. But the question here, is this rally sustainable? Or is it a trap with the market setting up for another big decline? Well, in today's video, we're going to discuss the different types of market recoveries, the current economic and political backdrop, and 3 possible scenarios that could shape the rest of 2025. So be sure to stick around because what's happening beneath this market rally might be a surprise to you. But before we dive into the video, guys, this video is for educational purposes only and should not be construed as financial advice. Always do your own research, and when you're investing, your capital is at risk. It's estimated that around 54% of Brits have some form of investment. And whilst we don't know exactly where that money is parked, I think it's probably quite safe to assume that a good chunk of it is probably held directly or indirectly in financial markets. And when it comes to global investing, well, the US market certainly looms large, with it making up 48% of the total value of global equities. Add that to a long-standing track record of outperformance, and it's easy to see why what happens in the US is important to investors all around the world. So whether you're checking your ISA, tracking your pension, or even deciding what your next ETF is that you're going to invest in, the future direction of the market is important to all of us. And right now, the question on many investors' minds is this: has the market really turned a corner? Or is this just a temporary bounce? Because yes, the S&P 500 is up 16% from its previous lows. But before we all start celebrating and coming to the conclusion that we're going to see net positive returns for 2025, it's certainly worthwhile asking, what kind of recovery are we actually seeing? V, L, W, U, J, these are all different types of market recoveries and different scenarios that the stock market could present us with. In short, these letters just depict different stock market patterns. And I'm sure there was probably one smart economist once upon a time who looked at a stock chart and thought, that looks like the letter V. Let's call it a V-shaped recovery. So let's talk about this a little bit more and decipher whether this is some kind of SHIT moment or whether it's just a V, W, or L. All of which will have a major influence on the future value of my investment portfolio, which is largely geared towards US equities. So it's certainly important for me personally. So let's break down these 3 possible outcomes: the optimistic V shape, the volatile W shape, or the dreaded L-shaped recovery. Let's start off with the V-shaped recovery. The V-shaped recovery is where markets provide a sharp rebound. It's the type of recovery that investors like me favour the most, because it means I don't have to look at my investment portfolio being sat in the red for too long whatsoever. It's as good as the recovery that we saw from Mo Farah back in the Rio Olympics in 2016. Where he fell over, quickly jumped back up, and then went on to win gold. That is the ultimate V-shaped recovery. But in financial markets terms, well, we have to kind of run the clock back to 2020 to see something that's equivalent, where the market declined 34% in just 32 days, but it then only took 107 days for a full recovery back to previous highs. We also saw something quite similar at the end of the financial crisis, whereby investors quickly shifted their sentiment from financial collapse to stronger economic growth. And investors might be expecting something similar now by looking at the current shape of the S&P 500 chart. Whilst there are many different factors to consider here, one of the factors that was the same in 2009 and 2020 was that during those periods of time, there was a fair amount of monetary stimulus that was taking place. Actually, in the financial crisis, the Federal Reserve increased the money supply by 13%. And 15.4% in 2020. Whereas now in 2025, there's still a little bit of monetary stimulus, but nowhere near what we've seen in the past. And then when you throw in the current economic environment with above target inflation at 2.3%, and a fairly high federal fund rate of 4.5%, probably unlikely that we're going to see any kind of aggressive monetary stimulus for the economy and therefore the stock market. However, money supply obviously isn't the only thing to consider when we're talking about the future performance of the stock market. Another factor to consider here, which is equally if not more important, is corporate earnings, because there's a positive correlation between corporate earnings and the S&P 500. Where the higher corporate earnings are, the higher the S&P 500 rises. Based on the latest set of earnings reports, which we have from a report written by FactSet on May the 23rd, for Q1, the blended year-over-year earnings growth rate for the S&P 500 is 12.9%. If we dive into the detail a little bit more, 96% of the companies in the S&P 500 have reported actual results for Q1 2025 to date. Of these companies, 78% have reported actual EPS above estimates, which is above the 5-year average of 77% and above the 10-year average of 75%. So the earnings story here is very strong and could be a factor in supporting higher market prices. However, future prices for Q2 provides a little bit more of a mixed picture. From the 87 companies in the index that have issued EPS guidance for Q2 2025, 47 companies have issued a negative EPS guidance, and 40 have issued positive EPS guidance. Overall, though, analysts are still expecting positive earnings growth for the rest of 2025. And that's despite one story which could have a huge impact as to whether this V-shaped recovery is actually going to be sustainable. And that story is tariffs. Now, the tariff story has moved on quite a bit since the Liberation Day on the 2nd of April. Since then, the UK and the US have come to some kind of trade agreement. Trump has agreed to postpone a 50% tariff on the EU as negotiations continue until July. And the US and China also agreed a 90-day rollback on tariffs a couple of weeks ago, so I guess progress is being made there too. However, this progress could be a little bit of smoke and mirrors because there's still very much a risk and a possibility that these trade negotiations break down. After all, Trump is still pushing a 20% tariff on the EU after the 90-day pause, and who knows exactly where these negotiations with China will end up. I think for me personally, this is one of the political and geopolitical risks that we're facing into because we simply don't know the outcome of these negotiations yet. However, let's say hypothetically speaking that these initial trade discussions do break down, then we could be looking at an alternative market recovery, which would be the W-shaped recovery. Or it could lead to another scenario which would be far worse, which we'll talk about in just a moment's time. A W-shaped recovery is a volatile one. It would result in a sharp decline in market prices, followed by a sharp rise back upwards, which we've admittedly already seen. But it would then be followed by again another sharp decline in prices, ending up with another sharp rise, resulting in a recovery. In economics terms, it would be like the double dip recession, almost like we saw in the US back in the early 80s. Whereby the economy shrank, then it grew again, then it shrank again, then it grew again, all within a fairly short period of time. If I take a step back and just think about this objectively, this whole kind of story around tariffs has been one of the core market drivers over the past few months, whereby when negative headlines have come out, market prices have declined sharply, and then when positive headlines have come out, then market prices have gone in the opposite direction. It has caused a hell of a lot of market volatility, which, whilst these trade negotiations are ongoing, then there's probably not an end in sight just yet. Like, if we look at what happened when Trump announced these reciprocal tariffs back on the 13th of February, well, the market dropped like a stone since then, teetering on the threshold of bear market territory. However, on the 9th of April, when Trump announced that he was going to pause the tariffs, well, the S&P 500 had one of its best days on record, jumping 9.5% in a single day. Which, for those of you guys who are slightly newer to investing, that is certainly the anomaly and certainly not the norm. To be honest, those kinds of market movements are pretty unheard of. And since then, positive momentum has obviously continued with these kind of ongoing trade negotiations. But hopefully what I've demonstrated here is how market volatility can intensify based on whether we're seeing positive or negative headlines coming out in the press. As of right now, there's an element of optimism coming out in the press, with the EU being willing to fast-track trade talks, which of course is positive, and the S&P 500 futures market, as of recording and researching this video, is also looking positive as a result too. But what we have to consider is what if there's another twist to the tariff story and things go south once again? What if the US and the EU can't come to some kind of agreement within the next few weeks and months ahead? What if the US and China can't come to some kind of agreement? The US and Japan? There's lots of other countries at play here where these trade negotiations could break down very, very easily. Well, this could open up the W-shaped recovery, where we do go a little bit of back and forth. However, what that could mean in the short term is that we may be due another sharp decline in market prices before ultimately markets go on to recover. The next phase of these negotiations are probably quite critical as to what the short-term outlook is going to be for the US stock market, with the 9th of July being the date that you should put in your diaries, being the next big milestone to look forward to. But then there's a third scenario to consider here, and this is probably the scenario that's most feared by investors, and that's the prolonged bear market or the L-shaped recovery. An L-shaped recovery would be a severe decline in market prices without a return to growth for a prolonged period of time. Now, this would assume, hypothetically, that there would be a permanent breakdown in trade negotiations between the US and the other countries that they're currently negotiating with. And as a result of that breakdown in negotiations, result in a deep economic recession for the United States of America. Let's layer in some context here and some potential outcomes, but let me just preface this by saying, of course, this is real, like, disaster stuff, worst case scenario kind of outcomes. Shifting back in time nearly 100 years to the Great Depression of 1929, whilst there are many different factors that contributed to the Great Depression, one of the factors that arguably made it worse was the breakdown in global trade as a result of the Smoot-Hawley Tariff Act in 1930. On the 17th of June, this piece of US legislation raised the effective tariffs on goods imported into the US to about 20%. Now, the aim of these tariffs were to protect US farmers and US businesses in order to maintain their overall competitiveness on a global scale. However, it backfired, with those global trade partners ultimately retaliating, and it actually resulted in a 65% reduction in international trade between 1929 and 1934. However, in 1934, US President at the time, Franklin Roosevelt, then brought in the Reciprocal Trade Agreement Act, which reduced the tariffs to promote global trade and cooperation once again. Unfortunately for investors, the damage had already been done, because the S&P 500 during that period of time declined by a massive 56.75%. And it took many, many years for the US stock market to recover to get out of the slump which was caused by the Great Depression. What I hope this highlights is the severely adverse economic outcomes that can come as a result of a breakdown in trade negotiations. As a slight segue here, but something that still very much remains relevant to this story, is the future outlook for the US economy, and whether these tariffs could cause a deep recession. Because right now, US GDP growth has reported negatively for Q1 2025 of minus 0.3%, showing a contracting economy, which isn't a good sign already. If we see a second consecutive quarter of negative GDP growth rates, then the US will formally enter into a recession. There is a real risk here that if economic GDP continues to decline and the US do end up in a recession, then the stock market may reflect those recessionary conditions that we saw in 2001, 2008, and even 2020, where the stock market declined substantially. I'd love to say I had a crystal ball to tell you with 100% certainty what's going to happen to the US stock market in the short term, but the reality is I nor anybody else can tell you that. I think on balance it's important to know the different types of scenarios that could possibly play out, but for me personally, it's not going to affect my long-term outlook on investing into the stock market. I'll of course pay attention to the stock market because it's what I'm interested in. It's how I kind of make a living making these videos. However, it's not going to change any of my decisions or actions about continuing to invest into my investment portfolio for the next 10 or 20 years or 30 years or so. And if you want to know how to build out an investment portfolio, then be sure to click on this video next. But before you do so, be sure to subscribe to your channel on the way out. With that being said, I'll see you over in the next one.